Welcome. This is the Insider's Edge to Real Estate Investing with James Nelson, the principal and head of Avison Young's Tri-State Investment Sales Group. In this program, you'll learn game-changing strategies to outperform the market. James will teach you how to source, execute, and capitalize on the best real estate opportunities in New York and around the world. Now, here's your host.
This podcast is for educational purposes only and should not be relied upon for investment decisions. The opinions expressed are those of the guests and not their companies. Listeners should not act upon the information without first seeking appropriate advice from an accountant, lawyer, or other professional.
Welcome to episode number 220 of the Insider's Edge to Real Estate Investing. This is your host, James Nelson. I'm principal and head of the U.S. investment sales here in Avison Young. And thank you, as always, for joining. Have with us today Greg Fournier, and we're going to be talking about scaling smart. So today you're going to learn how to build a real estate firm from the ground up in this conversation. Greg is the managing principal of Greenbrook Partners, a privately held, vertically integrated real estate operating company that maximizes value by instituting best-in-class management and redeveloping properties. Greg shares his pivot from being a NASDAQ trader to getting involved in real estate and making this entrepreneurial leap. You're going to hear about following an investment strategy and different ways to raise funds. Greg shares his insight into starting hands-on and building a 150-person operation with institutional partners, along with keeping a long-term perspective to real estate investments. Greg is a fantastic person, and you're going to get a lot of great advice and key takeaways from this as you think about how to scale your business, but again, in the right way. So as always, you can go to jamesnelson.com. That's where the show notes are for this episode. Again, I built this site for you. So while you're there, go ahead. You can sign up for our monthly newsletter that will aggregate all the great content that we're putting out each week to help you gain the insider's edge to real estate investing and achieve great success. So we're going to have a brief word from our sponsor, and we'll get right into that interview with Greg Fournier.
A different approach to putting our clients first. Avison Young's Tri-State Investment Sales Group sells multifamily, office, retail, development, and specialty sales throughout the New York metro area. As experienced thought leaders in their industry, our 35-member group is available to help you make informed investment decisions by advising you on your current holdings or identifying new opportunities in the marketplace. Our one unified team is built on an industry-unique platform which promotes unparalleled collaboration and teamwork. We share core values of hard work, integrity, and expertise. We put our clients first, providing tailor-made strategies to achieve superior results. Please visit us at aytristateinvestmentsales.com and follow us on Twitter, LinkedIn, and Instagram at JamesNelsonNYC to learn more.
Welcome, everyone. Thrilled to have with us today Greg Fournier, who is managing principal of Greenbrook Partners. Welcome. Great to see you.
Yeah, it's great to be here. Thanks, James.
So I think we're off to a good start because hopefully I pronounced your last name correctly. Is that right?
That's right.
I warned you in advance that I got a C in high school French, but you told me you were Irish afterwards. Yeah. But it is a French name, though. You did clarify that.
It's perfect. Yeah.
Good.
You got it.
So I know you're originally from Boston. You got your master's at SC in California, and you're back here in New York. So maybe talk a little bit about your journey. I know you were an economics major at Boston University, and then you decided to go in for your MBA. So did you go straight in to get your MBA, or what? Any stops in between? So
originally from Boston and did my undergrad at BU. Came to New York after undergrad. I was a trader, NASDAQ market maker for about 5 years, and then ended up wanting to shift careers, applied to business school, got into SC, and then after school came back to New York and began working in real estate.
Wow. Well, if you were still a market maker in NASDAQ, we'd have a lot to talk about, like the last week in specific. I mean, I don't know how much you still track the markets, but pretty wild.
Yeah, I mean, I still love the markets. It's been a crazy couple of weeks. It's had an impact on our business. We refinanced a couple of properties last week. Mm-hmm. But yeah, I mean, personally, I still enjoy tracking the equity markets and Yeah, I mean, maybe one day I'll get back to that.
Well, look, you certainly have quite the platform that you've built. So for those who do not know Greenbrook Partners, please give us a little overview on, what your holdings are. What's the investment strategy?
So currently the holdings it's about 400 properties in New York City. We pursue two investment strategies, a value add and a core plus. The value add is essentially targeting the worst building on the best block. We buy, renovate, lease, and then the plan is to recap or sell. And then on the core plus side, we're buying renovated properties that are leased, and the strategy there is to keep them tenanted, to improve the operations of the property, and really increase the property level cash flow over a long-term hold.
Got it. And right now, the specific focus has been in New York City, but we were talking before, you're open and exploring other markets as well.
Yeah, I mean, for us, so New York has been a great market. I think we entered at, an interesting time shortly before the rent laws changed. We had bought a few properties, and then, in response to that, sort of shifted the strategy. But over the last, 7-8 years, we've built this portfolio, and the pipeline is robust. When we look at the operating stats across these buildings, it's really remains a very attractive opportunity for us. And so we're actively buying buildings in the value add side. We're very active in the core plus side. Having said that, yeah, I mean, we've thought about diversifying geographically, entering different markets. As an organization, we've got 150-ish people. We have a couple folks on the West Coast in the Bay Area. We have folks in Chicago. We've been looking in those markets as well as the Southeast. We haven't done anything yet. Again, New York, it's still a very attractive market for us. And, we built such deep domain expertise here that we're still kind of full throttle in New York.
Great. And I definitely want to get back to, how you built the business here and to go from presumably, 0 holdings to 400 properties. I think I read somewhere $1 billion in equity that's been deployed, 150 people working for this organization. I mean, obviously, it's not just the acquisitions, but the management piece. So I definitely want to get back. I know a lot of our audience will love to hear about scaling a business, but I think it'll be helpful for them to kind of hear your experience on the real estate side and how you prepared yourself for this undertaking. So right after you graduate with your MBA at SC, was it there that you then went directly into real estate? Because I saw that you worked at the Oleon Group. Was that your first stop after school?
Yeah. So, originally my plan wasn't to get into real estate. Like I said, I was a trader before school. I went back to school, and, my plan was to go and work for, like a long, short or multi-strat hedge fund. But it was a really challenging environment. I had a tough time landing a job, and I ended up syncing up with the Oleon family, just coincidentally, who had a large public equity portfolio as well as this real estate strategy. And, so I started working with them kind of in the end of, second half of 2007. And they needed help on the real estate side. And it really didn't take long for me to kind of recognize the opportunity. I really enjoyed real estate. And I got to build out like a pretty unbelievable network while I was there. Yeah. So the family is well capitalized. It's sort of consistent with like sovereign wealth, and the approach is similar. So long dated, long-term strategy, but they were fairly opportunistic. And so if you found a good deal and the organization supported it, there was capital to do it. But I guess over time, I did sort of get the bug to do something a bit more entrepreneurial, and ended up starting Greenbrook in around 2015, toward the end of beginning of 2016.
So going back to Oleon, and if I'm not mistaken, I mean, they've transacted on some of the largest investment opportunities here in New York. I mean, I think they were the equity on 15 Central Park West, which for a long time was, I think, the largest sellout, not just here in New York, but around the world. So seemingly pretty opportunistic, investing in large scale development and all different asset classes, right?
Yeah, I mean, we were investing equity in development. We were buying existing assets. We were acquiring interests in real estate related operating companies. We were investing in publicly listed real estate companies and real estate related companies. It was a great place to be.
And were you involved in vetting the opportunities, vetting the sponsors, all the above? Because, and I think maybe they've done, some direct investing as well on their own. And I might have this wrong. I believe maybe they also acquired the Sony office building. But at the time, were they doing most of their investing direct, or do you have a sponsored development partner at the time?
So they were. The strategy sort of evolved, and so the origin of, I guess, their real estate strategy which predated me, was they were the equity in development, and they eventually shifted that strategy, investing in more traditional real estate private equity funds, which then shifted into funding, I think, a combination of, development, direct deals, as well as continuing the relationships with some of the existing, the private equity funds, and so they, it was like best in class organizations that they were investing with.
I mean, I would imagine that experience, learning how to work with, even though it's, a family office, I mean, still, run like an institution, understanding the importance of reporting. And I'm sure that was helpful when you ultimately ended up on, the sponsor seat, right?
Yeah, I mean, so I had exposure to, some of the most talented people in real estate in New York and in the US. And so to learn how they thought about, whether it was development, more traditional and, private equity investing, or corporate opportunities, it was a really good space for me to be in, because I had that exposure, and the people that we were dealing with were, like the folks who are at the top of the industry, so you learn best practices, not, I guess, on the kind of corporate reporting side. But for me, I mean, it was really about investing, and at the end of the day, that's what we do. We're investors, even at Greenbrook, it's a research driven investment approach. And I think
So from there, I think before you founded Greenbrook, you were a managing director at East End Capital. So what prompted that move to East End? How is that role different?
So it was an entrepreneurial platform started by a couple of guys who had been with Broadway, and their business was, maybe 10 people, a dozen people, and they had done a half a dozen deals in New York. And so for me, it was a good spot to go after having worked for the family office, because I wanted to transition to the operator side. And it was good exposure, because it kind of showed me, what it took to run the real estate.
Having exposure to office and retail as well at East End and residential, I guess the decision still to focus on residential, I assume what you would say is, even though residential is very challenging to scale, was that what attracted you to the opportunity? Did you figure, hey, if I can solve for these operating inefficiencies, I have something that is not widely available to the institutions? Yeah,
I mean, that's it. So we're probably the most dominant operator in the space, but that was, one of the genesis behind, pursuing the investment in the first place. I mean, it's really hard. I think you've got to be borderline crazy to do it, especially now.
Yeah.
I do think we entered it at the right time, but it takes a certain type.
Got it. So 2015, 2016, you decided to start Greenbrook Partners. Now, did you do this on your own, or did you have partners that were already in mind to launch this?
Yeah, no, it was in 15. It was just me. I had a financial partner, but we sort of struggled to put things together, which in hindsight, was great that happened. But in 17, my current partner, Fred Lacow, he and I got started together, and really we've been off to the races since then.
So for the first couple acquisitions, I mean, when did you kind of build the platform in an institutional way, knowing the goal was to scale this thing? So like when you were starting off, even for your first raise, I mean, was your first deal an institutional one, or did you have to like show some track record with some friends and family?
So initially we found a couple of buildings, two separate sellers, and we sort of packaged them together to get the size of the equity at a point where we felt like we could get institutional capital comfortable, and it didn't work out. So we ended up just having to pound the phones, raise the money from friends and family. And, in those early deals, we have 50, 60 people.
Why didn't it work out initially, calling the institutions?
I think it was probably the deal size, a function of the ability to scale. Yeah. We got a lot of pushback from from the institutional investors. They wanted to deploy 40, 50 million, and we hadn't quite demonstrated that we had the ability to deploy that kind of capital within this space.
So it's interesting because on one hand, I see, is this a large enough opportunity? But the other piece I would think is the track record, right? So clearly you could show that you've worked for some really impressive institutional shops in your past, but you haven't, as Greenbrook, done it yet. So was part of it like, all right, Greg, this sounds interesting, but come back to us when you've done a couple dozen of these? Or was there like buy-in from you from the start on your ability to operate?
No, there was no buy-in.
Okay. Because I've got to imagine a lot of our audience who's still raising money, friends and family, like the dream is to have, that institutional partner, much larger backing, that you can do more scale. But before we get to that, let's maybe talk a little bit about, those early deals, and obviously, working with the proverbial friends and family versus now what having, I would say almost exclusively institutional equity partners. So, I mean, if you had to kind of lay out, the pros and cons, if you want to call it, or the considerations, advantages, disadvantages of going friends and family versus institutional, how would you lay that out?
I mean, for us, we really didn't have a choice. So we started with friends and family. That first year, we closed the deal I mentioned, a couple of buildings. 6 months later, we sourced another opportunity and closed, again, capitalizing it with friends and family. The following year, we bought 10. The year after that, I think we did 30 something, and then we really started to stack, hundreds of properties. But it wasn't until I think toward the end of 2019 where we had evolved beyond friends and family and transitioned to programmatic joint ventures with institutional investors, which on the front end, instead of having to call 1,000 people to identify your 60 investors, I mean, it's nice not having the ability, to have to do that.
Yeah, I would imagine trying to line up 50 or 60 investors for a deal. That's got to be, I would imagine, early on, a tremendous amount of work was on the capital raising versus just, identifying and sourcing the opportunities, right?
Yeah, that's right.
Was there some might say, though, I like sticking with friends and family. There's better economics, because you don't have any, major decision makers on the other side. You get more flexibility. Do you think there's any pros to sticking with the friends and family, or does it gets to a certain size where you have to bring in the institutions.
Yeah, I mean, I don't think we have that many friends and family. So I guess for us, it's really like a quantum of capital strategy. So
Right.
when we had initially started, it was we're buying from non-institutional owners. We're going to create an institutional product. We would do it so many times such that there would be an institutional takeout, down the road. And fortunately, we've been able to do that. But there were lots of growing pains and challenges kind of getting the organization to that point.
So I know you mentioned early on some of the pushback from the institutions is that the deal sizes just aren't large enough. So, I mean, was there ever a thought process where instead of aggregating, and you could probably tell us what your average building size is. I don't think it's 100 units. I don't think it's 5. It's probably, somewhere in between. But was there ever a thought process like if I want the institutional equity, I've got to go take down 200-300 unit apartment buildings, or were you really convinced that the opportunity was more in the small to mid-sized deals?
Yeah, I mean, as an investor, that was really where we saw the value. And I mean, it's very unique in New York that you can do that, because despite, a bunch of people kind of running around putting deals together, you still have a lot of inefficiencies in the city. And so we were convinced that the volume would be there, that the market was deep enough, and that we would realize it. The other benefit of the scale, and really it being a more of a quantum of capital strategy, is that once you get there, you can really drive your OpEx down.
Mm-hmm.
And so fortunately, we've been able to do that as we've built up the portfolio. So now, we have essentially in New York a market with fixed supply.
Mm-hmm.
And, if we look back 2021, 22, we're getting double-digit rent growth. And then as we've scaled the portfolio, now we can realize on the cost side, driving the OpEx down.
Mm-hmm. I was involved in 2 funds, and we might have interfaced back in the day on it. In fact, we might have even invested alongside you. But River Oak, NYC 1 and 2. So we raised $50 million to put out JV equity and value add deals. And we really liked the space where we'd write $2 to $7 million equity checks. I don't know how we came with it. I don't know why we capped out at 7 or what, that exact range. But the thought process, or what we observed, was that 95% of the deals that sold in New York City were under, let's call it, $50 million in total capitalization. And yet it appeared that 95% of the institutional equity was focused on the $50 million plus. So you have this mismatch where institutional capital is looking for the larger deals, but all, the volume, right? When you aggregate it, maybe that's a different case, but there's just so many more deals. There's so much more deal flow in that small to mid space. So is that kind of what you were latching onto?
Yeah, that's really why we pursued what we pursued. Was because you had the opportunity set was really attractive,
right?
And then the volume supported, the second part of the strategy, which was, creating scale, buying enough that you could then find institutional capital. But yeah, you're right. The fact that the majority, really all of the institutional capital is targeting, deals that require 40 to 50 million of equity plus, is what makes what we're doing so attractive, right? When everyone is looking left and you go right, it's contrarian, but this is, as an investor, it becomes a really attractive opportunity.
So talk about, and you mentioned it, it's really interesting because this is a big theme of my book, about the inefficiencies of the marketplace. In fact, that's why we call it the insider's edge, because you can gain that advantage. And I want to circle back and ask you about the differences, because it's a much different approach than I would say investing in the public markets. But this idea of these inefficient markets. So, as you started buying these multifamily deals in, it was predominantly Brooklyn, maybe Queens, what was your observation with the way these assets were being sold? I mean, were you, I mean, first of all, let's start with how were you actually digging up these opportunities? Like if you're looking to do scale, how many people are out there looking, and then where were you finding these opportunities?
I mean, really, it's like you leave no stone unturned. So, we're equal opportunity. We look at deals from brokers, bankers, lenders, leasing agents. I mean, you name it. If someone has a deal and a realistic seller, then we will pursue it, aggressively, whether it's on the value add side or the core plus side.
Yeah. So across the board. Now it's funny. I had David Shorenstein on the podcast. I don't know if you know kind of his track record and approach, but one of the things he prides himself is finding these opportunities, and a lot of them off market. So he shared that, and I witnessed it going to his office, seeing, one summer he had interns who were just sitting there writing handwritten letters to owners saying, are you interested in selling your properties? He's now kind of automated that, if you will, but still this mass outreach. So if you're looking to do volume, you need to see a lot of stuff. So did you have like 10 acquisitions people too? Like how did you find the volume of the deal flow that you needed?
It's a small team. So when we started, it was more challenging. We were looking for something that checked, say, 9 out of 10 boxes. And then as we bought more and became, more talented on the renovation side, on the operations side, we could pay, incrementally more than, say, the next guy. And so we became a really good buyer. We don't retrade, and, we work with the brokers. And so I think ultimately what happened, the reputation began to reinforce itself. And so, if you really want to do well, and get the best deals, that is what you need to see everything, and so if you see everything early, the ones that check the boxes that you need checked, you can be really aggressive on the buy. And if they don't, then you just move on really quickly. But our acquisition team is small. It's just a couple of folks.
Mm-hmm. Talk about, and maybe part of your ability then, not to just find the opportunities, but then underwrite them, is, what checks the box and what doesn't. Because I think you said in your second or third year at Greenbrook, you closed on 30 properties. I mean, I think most of our listeners, they'd be happy if they could find 2 or 3 deals in a year. So I doubt you're going to tell us that to buy 30 deals, you bid on, 40 of them. I've got to think that, talk about that pipeline. Like, how many listings do you need to see? How do you filter them down to the point where you're actually drafting an offer? And then what's the success rate? Because even if you put an offer, obviously that doesn't mean you're going to win the bid.
Yeah. I mean, to your point with Shorenstein automating it, we've done a fair amount of automation on the acquisition side so we can operate lean, but we're making solicited offers on properties routinely. I mean, if we made, fewer than 15 or 20 a week, I'd be surprised, because oftentimes what happens is, sure, a seller may move to transact quickly, but a lot of times it's not the case. And so you've got to be diligent. You've got to stay on top of, whoever the rep is or the owner, and just perpetually follow up. You got to be persistent, and so for us, it's paid off. Deals come back, sellers get fatigued, circumstances change. And if you're always in the market investing, then those deals will come back and you'll get a look. And again, if the value works, we'll acquire it.
So let's talk about the value working. So I would assume there's some kind of buy box where you say, okay, this is our investment thesis. These are the type of returns that we're looking for. So I don't know if it's like a back of the envelope where you see a building and very quickly, you can figure out what you can pay. But what was the investment thesis? Was this just buy buildings, aggregate them, and hold forever? Is there a certain time and type of returns that you've been trying to solve for?
Yeah, I mean, so on the value add strategy, for example, the the acquisition basis sort of triangulates to the same point. The renovation costs generally triangulate to the same point. And then, given the amount of data we've got on the rental side, we have a really good understanding to like a very fine point of what we're going to be able to rent the units for post renovation. And so the math exercise is it's pretty quick, so if a deal is going to work or if it's not going to work, because we bought hundreds of these properties, we operate them, we have a look through into what's going on, not just in the rental market, but the financing markets. I mean, we've got just a ton of data. And over the years, we've figured out how to organize the data and then use the data so it informs the decisions on the acquisition side, on the renovation side, and on the rental side. Because in a certain neighborhood, if you want a 1-bed, 2-bed, 3-bed, a more palatial, whatever 2-bed, if it's going to work, within the micro market. And we've just gotten good at, collecting the data, organizing it, and then using it to make these decisions. And so when someone shares a deal, it becomes quite easy to just do some really basic math. And then, if it hits the return, then we move. And if it doesn't, then we move on.
So for hitting the return, so what is the most important metric for you? I doubt you're going to say cap rate, because these are mostly, although you said you do have some kind of core plus bucket of capital. So maybe you are looking at the in-place return. But for the value add stuff, is it like a stabilized yield on cost that where you're stabilizing? Is it kind of an IRR over a certain period? I mean, what is the ultimate return metric that you're solving for?
On the core plus side, it's between, I'd say, a 5.5 and a 6.5, depending on the strength of the neighborhood. And then on the value add side, I mean, we're generally targeting, we're basis buyers, so it would be per foot, and then yield on costs. So, where we feel like, based on the set of assumptions, where we would stabilize to.
Right. Which of course is, and I don't know how much of a spread that is over a core plus, but obviously you're taking on construction risk, time risk. So, I don't know if that's another 100 basis points that you're looking to reward you for your efforts.
Yeah. But, I mean, the yield on cost we're targeting is generally between a 7.5 and an 8.
Mm-hmm. So, and last week, I mean, I think the 10-year treasury swung by like 50 bips. So how sensitive to your underwriting are you looking at kind of macro trends? Again, we're recording this on April 14th. Tariffs were announced, then put on pause last week. Again, the 10-year treasury is all over the place. I mean, are you looking at where you can finance these deals? I mean, how much is your model or your return expectations change based on, whatever the macro trends are that day?
Yeah. So the day-to-day really doesn't impact the way we think about investing on behalf of our partners. Certainly, you can't avoid the noise, and you got to pay attention to the news and see what's going on. I mean, generally the long end of the curve takes time. It's, supply and demand dictates that. I guess the bureaucrats, the politicians have greater influence over the short term. But the reality is we've tried to set our business up such that if we have a deal that's really attractive, we have, capital to close all cash. We have, capital to the extent we're financing, that we would finance the acquisition. We're fine closing cash and then financing post-closing at some point in the future. But ultimately, if you have an opportunity to buy at an attractive basis, sort of irrespective of what's going on within the financing markets, that day or minute, whatever, we want to be in a position to buy. So generally kind of avoid the noise of the day to day, really trying to think long term, and for us, it's about, buying right, executing on the value add side, a renovation strategy, within, a cost-effective renovation strategy, and then leasing up.
So going back to my earlier question about kind of the considerations for friends and family versus institutional partners. So I would assume if your business plan was to do volume, so you've got certain institutional partners where, they've got their box as well. And as long as you hit the box, right, I would assume they're not looking, to just do a one-off with you. I mean, I would assume what you have is programmatic partners. And so assuming that is the strategy, that the question then becomes, how do you run that through in a quick, efficient process? Because, sometimes your institutions and you hear, it's going to be a protracted, contract negotiation, due diligence, whereas, buying in New York, which is probably the most competitive market, in the country, if not the world, like you can't sit around and wait for diligence. I mean, I would imagine a lot of the times you got to go hard on a contract deposit very quickly. So, how are you able to work with your investment partners to know that, you've hit the box, it can get through their investment committee quickly or whatever needs to happen so you can, go hard on an acquisition?
I mean, so it really depends on the partner and the strategy. So for our Core Plus strategy, the diligence is, it's super buttoned up. This is extensive diligence. On the value add side, I mean, generally we're buying vacant properties, and we can be a bit more, forgiving on the diligence, knowing that immediately post-closing, we're going to be starting renovations and really transform the property from, these days, a completely vacant and dilapidated property into something that, is nice, modern, clean, that, someone would want to live in. So in those situations, could you bring the institutional partner in after the fact? So you're basically taking down the deal, you're making, because it has to happen in a quick time frame, you're kind of cleaning it up and getting the diligence under wraps. So once you present it. Yeah. So we're not quite there yet. But we, the partners that we have on our value add strategy, we've set up a system such that, the approvals are very quick.
Got it. Okay. So now I'd like to talk a little bit about the management aspect and the operation. So I doubt, or maybe you self-managed day one, but, take us back to those early years, 10 acquisitions, 30 acquisitions. Was the goal always from the start to build up your own management company in-house so you could be vertically integrated? Was that construction, on-site leasing? I mean, how many of these things within the vertical did you want to have control over?
I mean, really everything, because we wanted to control costs. So we've always self-managed. More recently, the last couple of years, we started handling the construction. And more recently, last couple of years, we started doing all of the leasing. We had worked with, third-party contractors and leasing agents previously, but we just felt like the performance would improve if we had more control over that. When we got started, so there was no, Fred and myself, we're not wealthy guys, right? So we bootstrapped everything, and so we were doing a lot of the dirty work ourselves, some of the renovations. Really, yeah. Like all of the lower skilled work we were handling ourselves. So think like, demo and just some light carpentry. But yeah, I mean,
that sounds like they could actually be potentially a little fun to, knock down a wall or everything. I 25 plus years, I've yet to get my hands dirty.
Yeah. I mean, I think it sounds better than it is,
a lot. I would imagine a lot of long hours, a lot of weekends, because if you're out trying to deal make during the day, then I would, whether it's weekends or whenever you can catch up. I mean, it's like you said, it's all hands on deck.
Yeah.
I am curious though, the idea of kind of starting the management from scratch versus working with, a third party, right? I mean, wouldn't one of the concerns might be, well, this third party manager, they have, thousands of units. So, yes, there is that cost aspect, but you could say, well, look, because they are negotiating contracts across their portfolio, they can leverage, better pricing from their vendors. I'm also thinking about, GCs, same thing, like they're building multiple projects. So maybe they can get better pricing from their subs, not to mention that is their full-time job and what they're supposed to do. So do you think, for those listening, is there a case when you're starting off that maybe you start with the third parties, because that might also allow you to spend your time where it's most needed, and maybe learn along the way as well if you don't have the expertise to do some of these things?
So I think that that's kind of a consensus view. Mm-hmm. And, from day one, we really wanted to do it ourselves. We wanted to understand it. We had the owner mentality, and we felt like we were going to be making smarter decisions than some third party who had thousands of units, some GC who had dozens of other projects. So we were and have been very hands-on really since day one. I mean, it's, we've had, every problem in the book. And we had to work through, lots of different issues over the years. But I mean, ultimately, through the successes and the failures, we've gotten significantly better on the management side, on the contracting side, and even on the leasing side. I mean, when we would, for example, work with third party on leasing, they were really quick to, if the unit didn't rent in an hour or a weekend, to cut the rent. And, they weren't thinking about, if you do that across 10 apartments within a 10-unit building, the impact it's going to have on your cash flow and in front of a financing, refinancing, sale. I mean, it has a very good impact on proceeds, and so if we could control that, if we could, had the sort of staying power, the ability to wait, if we knew the way that, because we know the way that the math works, that ultimately the outcome will be better.
That makes sense.
For our partners.
So talk about how you built your company, because you went from, I guess, you and your founder in 2015. So you went from 2 people to now you have 150 people. So, for those listening who are trying to build their business, if you think about maybe the first 5 or 10 people that you hired for the business, what were each of those people doing, and what were the roles?
Yeah, I mean, we did everything. So we you're kind of taking the trash out in the office.
But did you have like a specific, okay, you're going to be an asset manager, you're going to be an acquisitions person, or just kind of everybody does everything when you started?
Yeah. So, Fred and I sort of split the roles initially, where he was maybe more focused on asset management. I was construction. We had a woman who I worked with at Oleon, who is still with us, who was handling accounting, property level corporate accounting. And then we ended up recruiting someone to assist with the leasing. But I mean, back then we were doing really everything. There was no job description. It was just, we were just like fighting to survive.
And out of those 150 people that you have working with you now, what would you say is kind of the common thread? Or if you're interviewing for a position, I mean, what do you look for in a candidate?
So we look for grit, we look for humility, and we look for people that are resourceful. So we've bootstrapped since day one. So there was, no one cutting checks. That allowed us to experiment with, fill in the blank. Every dollar that we made, we reinvested in the building, in the business, and as we've gotten bigger, we've been able to level up the team, identify, specialists, find really talented managers, and ultimately it shows up in the outperformance, which then allows you to continue reinvesting in the business, and continuing to level up the talent, and just making the I guess ultimately the performance of the underlying investment stronger.
So what would you say from an advice standpoint? And I'll ask this from a couple different perspectives. I mean, maybe it's the student who's looking to get into the business, and is it working for a big institution? Is it working? I mean, you still consider yourself an entrepreneurial shop. So that would be advice you'd give that person. And then maybe, the other question is someone who's maybe 5-10 years in the business, maybe they are already working for a big shop. They want to try to go do something entrepreneurial. What would your advice be to them?
So I think if you're undergrad or if you're 5 years out of school, so 27, 28, I mean, really that's the time in your life where you can be risk on. Mm-hmm. So I would just, find something that you're passionate about, but I would be mindful of, because you don't get to reconquer your 20s twice. I would be risk on, and I would really identify things that you've got conviction in, and then I would go after it.
Mm-hmm. Awesome.
Yeah.
And for someone who, I guess if they're 5-10 years into it and they want to, start off on their own and they've got an investment idea, at what point do you make the leap? Like, do you have to have the deal? Do you have to have the equity? I think, in talking to a lot of people who say, oh, I want to invest, I want to build up my own portfolio. Sometimes it's like, okay, well, what comes first? Is it the deal? Is it the equity? I mean, again, it seemed like it took a while. It took some reps for you to obviously scale it the way you have.
Yeah. So I had neither the deal nor the equity. The first deal that we did, I emptied out my bank account, and whatever I had, I funded the hard deposit, and then I funded the lender deposit, and really just rolled the dice.
And you didn't have the equity raised for it at the time?
No.
And how much time did you have to raise the money on that?
Whatever it was, we needed more. So I think we probably had 60 days, and it took, 90. Who knows?
What gave you the conviction to literally? I mean, this is like the equivalent of, well, maybe not going into the the casino, because this was not. I mean, obviously you had conviction in this, but to take that leap, to put everything on the line, to try to raise the rest of the money in 60, 90 days, whatever it is. How did you know you could do that? I mean,
yes, I guess the money or the deal, I didn't have either, but I did have the conviction. And, that moment with those two deals, I really felt like they were good buys and it was going to work. So I just believed we were going to be able to do it.
Okay. And any sleepless nights before the closing and wonder if it was going to all happen and come together?
Yeah. I mean, the lender retrade. I mean, it was like a pretty awful experience. I wouldn't want to do it over again.
Right.
I mean, each deal has its own sort of set of challenges, particularly in this space when you're buying from, kind of mom and pop non-institutional owners who, may have, connection to whatever the underlying real estate. And so you got to work through that. But, the first deal for me was the hardest, and certainly I wouldn't want to go and repeat it. I mean, now, it's kind of like like if you're kind of a day in working in the ER, whatever comes through the door, it's brand new. And so it's unsettling. But if you've been doing it for 20, 30 years, you've seen it all. And so you don't, you just know that whatever it is that comes through, you're going to be able to handle it. You might not have seen it, but you've probably seen a version of it. And so these days, I feel like we've seen everything.
Yeah. I mean, 400 deals and counting, I could imagine that. So Greg, as we wrap, and this kind of brings us full circle, because, the fact that you started off as a trader, right? And I would imagine in a public market where information, theoretically, everybody has access to the same information. So you're going for something that's a highly efficient marketplace. And then you've got real estate, which is, you could make the case very inefficient. Like, kind of thoughts on why real estate is a better investment opportunity because of that factor.
So I guess in the private market, in the space that we're in, the inefficiencies are significant. So still, New York City, like to your point, it's the largest, most liquid real estate market in the country, and probably, one of the top 5 or 10, whatever, in the world. But you still have this arbitrage, and for us, because we have a substantial portfolio, we've got a look through into costs and rents. We can sort of back into a good buy, and so for us, we're really well positioned to capitalize on the arbitrage because we know, sort of what it costs and the time it takes to execute, and we know post renovation, once it's leased up, what the value is going to be, and you just can't really find that in the public market.
Mm-hmm. So what's amazing to me is I've been doing this now for over 25 years, and I guarantee you there are, brokers, my competitors, that are still doing business the exact same way they did it 25 years ago, even though we're at this golden age of data and technology. So, I mean, maybe that's also, I'd like to think that's some of our competitive advantage in here and how we, leverage technology and data. So, I mean, how much of this, thinking about, the next, so you've been doing this with Greenbrook for, 10 years, like thinking the next 10 years, how are you leveraging technology? How is the business evolving? And then I guess ultimately is the goal, is it another 400 buildings? Is it another 4,000? I mean, what's in store for the future?
So when we look at the performance of the deals that we've round tripped, so we're sort of blending to a 1.5, 1.6 multiple, and a little less than a 30 IRR over, on average, a 24-month hold. And one of the reasons we're able to get there, is certainly because of the team, the process, the protocols that have been set up, and it's our use of technology so that when the handoffs are occurring between asset management, construction, leasing, property management, that we've really kind of shortened and tightened up the execution, the investment life cycle. And, so for us, we invest heavily in the team, but we're also investing heavily in technology. And we've got really smart people that are doing some experimental things with non-traditional real estate tech. And I think it's going to be an area where we continue to invest to try and eke out additional gains. But I think for us, going forward, we'll diversify the business, invest in other geographies, probably other property types. Within New York, the majority of our 400 properties are, say, on the smaller side. And there's really no reason why we couldn't leverage the team and the expertise that we built to invest in larger properties. But, ultimately, I guess your guess is as good as mine, but we're really bullish on New York. We think it's still a great opportunity. And so I think we're here long term.
Wow. Well, Greg, this was amazing. You built an incredible business here, and we're so grateful that you shared your story. I know this is going to be super helpful for our listeners. So thank you again.
All right. Yeah, thanks for having me.
And thanks again for everyone who joined. As always, you go to jamesnelson.com. I built this site for you. That's where you can find the show notes. You can find out how to connect with Greg, as well as a lot of other helpful resources. So I think the best thing that you can do, and I don't know how you could not have benefited from this conversation, is, we just heard advice for someone starting in the business, someone 5-10 years out, how to scale a business. There's got to be a couple people that you can forward this episode to and get the word out. So we would greatly appreciate it. So until next week, thank you again for joining.
Thank you for listening to the Insider's Edge to Real Estate Investing. We appreciate your subscribing and sharing with your friends. If you haven't already, please connect with James at James Nelson NYC on LinkedIn, Instagram, and Twitter. Please also visit jamesnelson.com, where you can find the show notes and other episodes, along with an exclusive video series and other helpful resources, so you can gain the insider's edge to real estate investing. Until next week.